PZ Cussons is an international consumer goods company with 140 years of trading history. It owns and builds brands across personal care, home care, and baby care, including Carex, Imperial Leather, Original Source, Sanctuary Spa, Morning Fresh, Tropez and Cussons Baby. Its priority markets are the UK, Nigeria, Indonesia and Australia, which together account for around 85% of revenue. There are 5 compelling reasons why PZ Cussons represents an attractive investment opportunity. 1. Locally loved brands with high market shares. PZ Cussons does not sell generic global products. It builds brands that are deeply rooted in local consumer habits. And the result is a portfolio with impressive market positions. Carex holds around 37% of the UK liquid hand wash market, twice the share of its nearest rival. Morning Fresh holds 50% of the Australian washing up liquid market, 3 times the share of its nearest competitor, and 56% in Nigeria. In Nigeria, 70% of revenues come from brands that are number 1 in their categories. These are durable, hard-to-replicate positions. 2. A more appropriate strategy is delivering results. Under Chief Executive Jonathan Myers, who was previously at P&G, PZ Cussons has become much more obviously marketing-led. Its ambition is to build brands. The results are becoming visible. Management has set a clear ambition: mid-single-digit revenue growth and high single-digit earnings per share growth annually, implying a double-digit return for shareholders when combined with the dividend. 3. A rebalancing in investment. PZ Cussons is doubling its R&D spend by 2027 and shifting its product pipeline from 90% renovation to a 50-50 split between renovation and innovation. This is a meaningful change for a business that previously underinvested in new product development, and it should drive new customer recruitment and revenue growth over time. 4. A restored balance sheet. After the sharp devaluation of the Nigerian naira in 2023 stressed the balance sheet, management acted decisively. Asset disposals and cash generation have reduced net debt from £112 million at the end of full year 25 to a consensus forecast of around £30 million by the end of full year 26. This includes cash balances in Nigeria, which stood at £24 million at half 1, 25-26. Controls are in place to limit currency risk going forward. 5. Prospective earnings growth is not fully discounted. Higher profitability is invested in innovation and brand building, which increases the certainty of future growth. On this basis, PZ Cussons is beginning to stand out. Consensus forecasts point to 13% earnings per share growth in full year 27, ahead of most peers. Were this growth to carry a higher level of certainty in the market's mind, the prospective price-to-earnings multiple of 12 times on consensus forecasts would be significantly higher. If the company maintains guidance, the market's confidence will increase over time. If you would like to learn more about PZ Cussons, please see our latest research on the Edison website.